Good evening and welcome to the September 16th edition of Bond Squad After Hours. I'm your host, Tom Byrne. Let's get down to our disclaimer. So we had a little technical problem. As you see, we're broadcasting from the new location in Wilkes-Barre, Pennsylvania, WSNM LLC Bond Squad North. And I'd love to be able to find the disclaimer. I might have to wing this one because we are having all kinds of internet problems up here tonight. A new office with new equipment, and okay. This broadcast for informational purposes only. Bond Squad and Wealth Strategies and Management LLC are separate entities from Private Advisor Group. Private Advisor Group is a registered investment advisor. Information broadcast on this show are for informational purposes only and not intended to be an investment recommendation for anyone. Well, tomorrow is almost here. I try to queue up tomorrow from the movie Annie, but that's not. Again, the net's not cooperating. But tomorrow we'll finally have our much anticipated Fed rate decision. Now, will that be? Will the Fed actually tighten or not? Excuse me one second. We have a technical problem. Now we're back. Okay. Will the Fed tighten or not? My guess is that the Fed might. I think the Fed should. The economic data is, while not spectacular, is solid. And I don't believe the 5.1% unemployment is really 5.1% unemployment. And when you factor in the very low labor force participation rate, but we don't need zero or close to zero. We probably need somewhere around 1 right now. We're not going to get to a 1. Maybe we get to a range of 1/4 to 1/2 if we're lucky tomorrow. Could see a range of 1/8 to 3/8. Might not see a tightening till December. Might not see a tightening until 16. Depends how dovish the Fed is and how much the Fed is concerned with overseas developments. So, that's what the market is anticipating. Is some sort of clarity anyway, if not an actual tightening, a clarity on what might lie ahead. Well, what might lie ahead is probably, no matter when the Fed tightens, if it's going to be tomorrow or in October or December, January next year, March at the quarterly meeting next year, excuse me, the Fed's probably not going to do very much as far as how much it's going to tighten and how fast it's going to tighten. We're probably looking at something like, at least Bond Squad's forecast was not above 1% by the end of next year, and probably hitting a peak or terminal rate of the mid 2% by 2018. Well, lo and behold, a CNBC does a survey, and they come up with pretty much just that. The CNBC survey is forecast a 2.7% terminal Fed funds rate in Q1 of 18. All right, it's a little bit higher than what I thought, but I thought maybe 2.5, 260, but 270 is close enough, right? Shot to pieces, it was the theory that we're going to renormalize. We're going to see Fed funds rates, short-term rates go back to where they were. Probably not going to happen. Now, about tomorrow, the markets seem to be all over the place. The equity markets rallying going into the Fed meeting. Is it trying to predict something? Well, the equity market tends to rally into Fed meetings, and maybe there's a hope that the Fed is either dovish, or if it tightens, says we're going to be dovish and the economy is getting better. So another Goldilocks scenario. We saw interest rates shoot up on both the long and the short end of the curves. The long end of the curve, right on 229 on the 10-year. Last I looked, is not anywhere close to the post-recession high. But if the 2-year, when it popped up to 79 basis points, now it's closer to 75 basis points. It became the highest 2-year note yield since 2011. So basically what's happened since then is the curve has flattened somewhat. That's what I think will be the general trend going forward. Now, could you see long-term rates pop immediately after the Fed says it's going to tighten? Possibly. But I think the general trend would be for the curve to flatten. Maybe the 10-year goes up to 230, 240, 250 by the end of the year. Could even visit higher than that if there's some more confidence out there, some inflation pressure that I don't see. But there's really not a whole lot of upward pressure on rates. Yet over and over again, we keep it rising rates, buy loans, buy floaters. Guys, Florida's a junk, all right, for the most part, especially loans. Right, they're going to be hit by probably wider credit spreads, tighter credit conditions, and if we do see a rate rise, it could put some of these issuers under pressure. So you have to know which loans you're exposed to. If you don't, you might have a problem. You might not. Remember, rising rates don't automatically give you a higher rate of return. They can also give you a higher rate of default or delinquency. So, we still prefer moving up in quality, taking some duration risk instead of credit risk. And I'm not overly concerned that we're going to see high rates anytime soon. And here lies the problem. And it was highlighted in the journal again today. Lee Cooper mentioned it last year. I've mentioned it ad nauseum. There are money managers out there, there are financial advisors out there who have never seen a Fed rate hike. They know everything about rate rises in theory only. And they make the assumption, many of them do, that when rates rise, well, all rates rise. I've seen wholesalers come through our offices, and it makes me want to like scream. So, oh yeah, rates are going to rise. Rates are probably not going to rise all that much. And that's what we have to understand. The Fed is going from, will hopefully go from extremely accommodative monetary policy to just extraordinarily accommodative monetary policy. There's not going to be a whole lot of real rate hikes going on here. It's not that Fed policy can become constrained. Well, then why is everyone worried, or many people worried? Because they're stretched out for yield, and they're banking on these correlation models, which have blown up again. We saw the risk parity guys take it on the chin last month, and they're hoping that we see some sort of return to correlations and some worry that we might return to previous correlations. Everybody says, "Oh, I'm a believer in reversion to the mean." There is no mean. There's no such thing as a mean in economics or in investments. Okay. Conditions revert to fundamentals eventually, and sometimes the fundamentals are similar, but there's no guarantee they're going to return to any past condition. And if you look on a decade by decade basis, that's correct, that we never have returned to conditions of the prior decade. Now, within the decade, you see some similarities, and even between the decades, you see similarities, but it rhymes. It doesn't repeat. And that's what everybody out there, or not everybody, I shouldn't use that word. I use that too much. That's what many people think is going to happen. Okay. So remember, the Fed might say tomorrow that it's accommodative, but it might raise rates at the same time. And we have to put this into perspective. A Fed funds rate of 1/4 to 1/2, and I'll say, or even between 1 and 1.5, is not tight policy, even though I think tight policy is at a lower rate than in the past. So tight policy might be 2.5 to 3. That goes along with the CNBC survey of a 2.7 terminal rate. All right. So interest rates are not likely to pop anytime soon, and we're probably going to see continued disinflation exported from overseas. And we're seeing labor saving and price saving technologies put in place over here. For instance, Alcoa just announced a new process where they can create coiled steel at a fraction of the time with less labor, and they're going to supply more aluminum to Ford Motor Company for its new aluminum-laden vehicles, right? So there's not a whole lot of wage pressure. Yes, real wages went up by 2.3% as the last measure, up from a downwardly revised 2. That's better, but it's happening mostly at the margins, and it's being really skewed by high-end jobs, in special skills and education-intensive jobs, and some help from recent rises in minimum wage. But that great middle ground has been hollowed out. The cubicle jobs that were $50,000 to $75,000 a year jobs have been gutted, have been sliced out of this economy in large part. Okay, so I don't think we're going to see that much wage pressure. And remember, the wage pressure is coming from a lower base. In real terms, U.S. wages are about where they were in 1995, 1996 right now. So we've lost about 20 years of wage increases, or what we should have had in wage increase. We're back to where we were, back in the 90s. So So much for the improvement. So inflation is likely to stay low. We're likely to have only modest Fed tightening when it happens. Long end of the curve, I stand by my statement. I don't think that we see a yield curve with any rates above 3 or much above 3 when it goes flat. So that means the Fed funds rate might come into the mid twos, but the long bond can come down below 3 again. It's at a whopping 307. We saw the street consensus forecast as per CNBC for the year end for the 10-year note come down from 3 to 260, and now today to 240. I'm in that 240 camp for year end. I might be high at this point. I don't know, but 240 seems a whole lot more logical than 3. Yet, and mostly come from the equity and MPT guys. No, 3's coming. 3's coming. Yeah, the next ice age is coming too at some point, but we probably won't be around to see it. I hope I'm around to see a 3% 10-year note. Shouldn't be that long, but it's probably not coming, this year or before my 50th birthday in 2 years. So that's where we stand with that. Now, there was a lot of confusion yesterday, and it's still not exactly clear what caused the bond market volatility we saw yesterday. And for those of you who might not have been in direct touch with the U.S. Treasury market, we saw both long and short-term rates pop, as I mentioned earlier in this broadcast, with the 2-year coming up to a 4-year, almost 5-year high. So the curve moved almost parallel, a little bit of flattening. It's pretty much parallel yesterday, but the short end moved higher. We looked around, we read comments by other firms, we asked our trader friends, and no one could find a fundamental reason for what happened. So it looks like there's an unwinding of a trade or a putting on of a new trade. And I think that's happening in equities too. I think you see an unwinding of a trade, maybe a short trade, or a putting on of a long trade, and they buy on rumor and sell on the fact if they get a tightening. So there's a lot of technical things going on. And the problem in this industry right now is that investors and to some extent advisors have been trained to dislike volatility and to try to hedge it out of portfolios. My opinion, that's just a way to hold more equities than one should. I want to hold a lot of equities, right? But I don't want the volatility equity. So I'll come up with this creative algorithmic strategy that lets me have my cake and eat it too. Those strategies work sometimes and they don't work others. Again, risk parity. Now, risk parity might work. I'm not an expert at it. I know what it involves, but might work 7 out of 10 years, maybe even 8 out of 10 years. It doesn't work 100% of the time. And if you are close to needing to spend that retirement savings and you're in a year that risk parity or any other strategy designed to let you have your equity cake and eat it too, it doesn't work, well, then you're selling into a down market. If you need to start consuming your savings, in my opinion, you need to have income. And if you can hold to maturity and have your maturity staggered, laddered, barbelled, it doesn't matter, does it? It's all noise. Nobody's out there selling your bonds unless you have an active manager like an SMA guy who's just trading for total return. He might sell into a bad market, or if you own other types of investments where other investments can give you realized losses, you don't need to worry. You don't need to worry a bit. Just buy your bonds, ladder, know your credits, hire somebody who does know how to do it, and move on. It's not difficult. What we can't fear is our rising rates, and we can't try to game are, again, rising rates. There's no foolproof way. If it was just so easy to buy floaters, right? How come floater performance, if you look at various floating rate vehicles, they peaked in performance and in value in 2013, right? So if everybody and their brother thought that these are the greatest things to own, how come the institutional side lightened up on them in 2013 and 14? Oh yeah, nobody wants to say that. They peaked, okay? It's not getting much better, and your coupons are likely to float much, if at all, based on some of these floors and where you'd have to come up. How far? Some of these things are 100 basis points. They have a floor that are 100 basis points above LIBOR, right? And it might be 2 years before we see LIBOR go high enough to move any of these floating coupons a basis point, or maybe a year and a half to 2 years. Now that might be good because it might save some of these issuers from defaulting. Maybe not. I think credit spreads are going to blow out on the real risky stuff, but you're not getting the benefit of it. Float is just it's not a no-brainer. This reminds me of back during the financial crisis when a large investment firm went to several cities. Well, actually, it's more than one, but there's one I remember. A large investment firm went to a decent-sized city in Pennsylvania and convinced them to swap their fixed-rate cash flows for floating, do an interest rate swap, right? And it was a no-brainer. This was like 06 or 07, and the economy was booming, and the Fed's probably gonna have to keep tightening, and that's gonna boost short-term rates. So you don't want to be locked in this fixed rate. You want the floater. And what happened is that the Fed, because of cracks in the economy and the mortgage market and whatnot, started to ease unexpectedly. And these people bought these surefire floaters, these entities, in this case, not floating rate bonds, but floating rate swaps. Again, they're floating off of LIBOR. They swap their fixed cash flows to a counterparty. Somebody's going to give them floating. So their interest rates come down. Their income drop. I personally reviewed a portfolio for a nonprofit a few years back, or I think a year ago, actually, and they did the same thing. And they couldn't understand how come their income kept going down. Well, they were linked to LIBOR, and LIBOR is almost always joined at the hip with Fed funds, and down it went. So now it's supposed to be surefire. The Fed is going to raise rates, and that's going to make your floaters pay more. Problem is, like I said, some of these, most of them would require LIBOR going up 100 or so basis points from where it is now, maybe a little less, maybe a little more, depending on the structure, before you saw one basis point increase in the coupon of the floater. So maybe you get between now and peak Fed funds, and then after peak, this Fed starts to ease again. Maybe you get a full 100 basis point increase on your coupon over the next few years. Your average return might not do any better and could do worse than just buying a fixed coupon over that time. And that's how the market prices things, right? They price things fixed versus floating. So if it appears that a floating rate would be better, a floating rate vehicle would be better, the cost of buying it goes up. If it's felt that a fixed rate would be disadvantageous, the price goes down. And they should equal value over time, right? So one should not be advantageous over the other. And the same is kind of true of tips versus treasuries, by the way. The 10-year treasury prices, versus inflation pressures. That's what the long end does. So, what you have to do when you decide whether the 10-year treasury or the 10-year tips is which one is a better investment, you have to look at a break even. And that's the difference between the two yields, right? So if the difference between the 10-year treasury yield and the 10-year tip yield is 150 basis points, that means if inflation runs better than 1.5, higher than 1.5, the tip is better. Below that, it would be the 10-year actual treasury would be better. Okay? But in theory, if that forecast is right, and we do run a 1.5% inflation rate, it would not matter which you own, the tip or the treasury, because they'd be even. That's the break-even rate. So, the market tries to price in and price out interest rate and or inflation moves. It's not like, oh, buy a floater because like no one else has thought of this, guys. You're the only ones who figured this out. Buy a floater because rates are going up. Market prices that in. The idea is to do this when it doesn't look like they're going to go up, when they're out of favor. And the time to buy a lot of these floaters was 2009, 10, 11, and maybe the beginning of 12. After that, they were fully priced in and maybe even overpriced for a while. So, that's where we go. And the other thing is, when we saw the move in treasuries yesterday, the upward move in yields, some of our readers were surprised because when they went to look at corporate bonds and municipal bonds this morning, the prices didn't drop like treasuries did. And in fact, in some cases, they rose. And we received questions, hey, is the guy on the desk, working me over? I mean, he raised the price with bonds sold off. Remember, folks, corporate bonds and municipal bonds are not interest rate products. Yes, they're influenced by interest rates, but they're really credit products. So if you remember what happened during the during the correction, the equity market correction, right? We saw treasuries rally, maybe not as much as some people thought, thanks to the Chinese selling, but treasury prices rallied and yields came down. We saw the 10-year flirt with 2% again, actually went through temporarily, right? But the yields on corporates and munis really didn't follow it down. What happened? The credit spreads widened, and what we've seen since treasuries have sold off again, the credit spreads have narrowed, and we can prove this for various asset classes by some handy charts we put together today, thanks to the folks at Bloomberg and Bank of America Merrill. And let's see if we can bring this nice little chart up, if our system will cooperate. Let's see if this brings it up. Let's see if this bad boy works in. It doesn't seem to be cooperating. Let me try something else here. Stop sharing. You get to see my handsome face again. Let's try this again. This internet connection is very, very slow here. Let's try this again. Photos. Oh, I took a copy of this anyway. Oh, well, I have it on the desktop. I'm trying to share the screen, and my screen sharing is not cooperating. Anyway, we'll post it on the website when we update our charts. Basically, in the last 3 weeks, after blowing out, credit spreads have narrowed. What's happened in the last 3 weeks to treasuries? We saw treasury yields come back up very slowly, right? So we see that compression. My feeling is that if the Fed tightens, you're going to see spread compression in most credit products, at least initially. But at some point, when you start to see stress among the high yield and emerging market issuers, what you're going to see is spreads widen out again. And I think we're going to see a very credit specific event happen where we see spread compression on higher quality bonds and spread widening on lower quality bonds. And that's what I think we're going to see happen as we get closer to normalization. And honestly, folks, we are thousands of miles from normal or neutral monetary policy. So we're probably thousands of proverbial miles from normal credit market conditions. All right. So that's not going to happen overnight. So you probably have ample opportunity to move up in quality. And that's what I would do. And that's what I have done in portfolios. Let's see what else we have on our agenda. I think we covered just about everything early. So there's something I want to touch on. As you know, we have Bond Squad. We manage portfolios for investors directly who don't have an advisor, and at times through financial advisors at other firms and in my own firm, of course. And I try not to have a conflict like some firms do, where I'm dealing directly with clients and financial advisors. I really wanted to make this more of a financial advisor centric operation. But what's happening now to me out there is that many of the firms I deal with do not want or are reluctant to put custom managers on their platforms. They want managers to have a prefab model they can observe, right? So they want us to shoehorn everybody into prefab models, and I won't do that. So I've been told by at least one firm that they probably will not approve me fully for their platform because they don't want custom. I'm not changing that. I could do it. I could create 5 portfolios and cram everybody into it. I can use only the biggest and most liquid bonds, so they're the go-go names, and I can get them all the time. But by doing that, for one, I would be leaving some of the better values, out in the street, not bringing them in for my clients. And secondly, not everybody has a different situation. Why not try to build a portfolio that meets that particular client's situation? A lot of work for me, but I'm willing to do it. So, that's my goal here. So if the firms don't want to put me on the platform, that's fine, but that forces me to go and deal directly with the public. And I will do that if I have to, because I believe this work is that important. I believe that every investor is entitled, regardless of the size of their investment, to the most customized portfolio that is realistically possible. Now, obviously, a smaller amount of money, you can't build a large custom portfolio of individual securities. We have to be more macro, as it were. But for larger accounts, we can get very, very specific. And that's my job here at Bond Squad, at WSNM, is to be specific, is to add value, is to not be the robo-advisor. Honestly, most investors can go to a automated platform and get a portfolio that's probably good enough or just good. But good is the enemy of great, right? And you get what you pay for. So my goal is to build that custom portfolio for clients, because what's coming down the pike here is probably something that we've not ever seen before, and that is a Fed that is going to tighten very slowly and not move rates very high, while the emerging market story is probably going to disappoint on the lofty expectations that were put on it. And the U.S. economy, due to demographic reasons and some also poor policy choices, is probably going to chug along in the twos. That's what the market's predicting, that Q3, which should be one of the driving quarters this year, to be a 2.5% to 2.75% economy. And that's the driving one. And the market's like, this is great. It might be great for what's going forward. So that's where we stand. That's probably where we're heading at this point. All right. So what I think is that we all have to be tactical. We have to acknowledge that we're not we're in a new situation. We've never been here before. We have to think outside the proverbial box. We have to have our hands on the wheel and be able to steer portfolios around the speed bumps. Not trying to plot the most likely course that won't hit the speed bump, because sometimes a speed bump appears where you don't expect it and you need to move. And you can't say, well, I can't because the model doesn't let me. That's poor management. That's very poor management. So that's all I have for this evening. There was one other thing I really wanted to touch on at the last minute, but if I think of it, I will mention it in tomorrow's report or the weekends in the trenches report. That's all I have for tonight. Have a great night. Remember, I think there's a 50% chance the Fed could go tomorrow. Either way, dovish language, and the sooner they tighten, the slower they'll tighten, and potentially, the lower the terminal Fed funds rate. We'll see what happens tomorrow. I'll be out with a commentary probably in the weekend in the trenches report. You know what? Let me see if I can arrange to have another broadcast here, probably from the Stroudsburg office, and we'll discuss this. So we'll see you tomorrow, maybe. Have a good night.